Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso. We just wrapped up our interview with Aaron Chapman. Anthony, what was a takeaway or two that you had?
Well, I knew Aaron was going to drop some wisdom, and I will say that he is sharing his screen. So he's talking through that. This would be ideal watching through YouTube, but he is explaining it orally. So I do think that you can follow, but you just realize he's talking a little bit while he's sharing the screen.
Mm-hmm.
But a couple highlights, and one I didn't even expect to hear, but he had talked about at the beginning of how he's able to produce such a high volume of mortgages. And it's because he had worked on his processes and procedures. And I think that's just something we need to take a little time. How important is it? People that are scaling their business and are successful, they typically have these procedures and processes documented so their team is able to follow. So I thought we were going to focus on interest rates, but he was adding some information that I think everybody should know in regards to running a business. Now, he spent almost maybe 20 minutes answering the question, how are interest rates determined? Which he gives a very thorough about the money supply and kind of the mortgage-backed security. So I think he dropped some very good information, particularly about how some government policy is going to affect those. So another very good episode. Cameron, what were some of your takeaways?
Like you said, he talked about kind of this processes and procedures, but he did spend a lot of time talking about interest rates. And really the thing that I took away here was there's a lot of talk about the money supply increasing and what's happened 2008, 2018, 19-ish.
Mm-hmm.
And then also just in the last couple of years and how much money is now actually out there and what that does to the dollar value. And my takeaway was really just how important that 30-year loan is as a financial tool and how readily available it is to regular people. Oftentimes I don't think people are putting enough emphasis on what that tool can do for you to create wealth. And so Aaron touches on that today, but he's also got the app that he discusses that allows you to go in there and actually do a little bit of math and put some of those numbers behind that idea. So really good interview again with Aaron Chapman. Aaron is a veteran. He's been in the finance industry since 1997. His experience is in the complicated. Presently, he was ranked number 7 in the U.S. With over 1 million licensed loan originators. That's a pretty impressive stat.
Mm-hmm.
But Aaron is the battle-worn partner of every real estate entrepreneur needs to walk through the tough parts of building a real estate business. Hope you guys enjoyed this interview again with Aaron Chapman.
Enjoy the episode.
Take care.
Welcome to the Infinite Wealth Podcast, where we teach clients how to build wealth and create passive income without the risk of Wall Street.
All right, listeners, welcome. We have brought Aaron Chapman back once again. Aaron, we've been on, I think you are the 3-peater on our episodes, which I think is the only one.
3-peater.
Exactly. But for those, our podcast has grown in the recent years. If you could give our listeners just a little bit about your background so they have an idea who we're talking to today.
So 3-peaters, that means on the first time there was nobody listening, right? And
yeah.
Now we're getting that point.
I think my mom was listening. Yeah.
So I've been in the finance industry since 1997, focusing more on the mortgage side of it, right? And really heavily focused on the real estate investor. There's a couple different outfits in the world that track us as loan originators and kind of see what we got going on out there and keeping stats. And in those stats, there's over 1 million people in the United States that do the job I do. I was ranked number 7 last year because I have a badass team.
Congrats.
Right? So I've been able to get out there, shake my ass like I'm late on rent to drag in business. And then I have a team that gets it done so people want to come back. There's nothing worse than just working your ass off to get business just for it to fall apart because the people you work with suck. So that has helped me a ton to build up a really amazing following of people to do business with. And actually basically ranked number 1 when it comes to the real estate investment space. Now we do loans for people buying houses to live in, vacation homes, debt service coverage ratio kind of loans known as DSCR, some of your commercial stuff, blanket loans to do multiple houses under one loan, construction, rehab loans, all kinds of stuff. But we really focus on the conventional lending for people because the banking industry sucks at it. So that's where we focus a lot of our time, energy, to help people get involved in investment real estate in times that they're very uncertain because most people don't understand it.
I would say, Aaron, how with all those transactions, I mean, it sounds overwhelming on how one person can handle that. So how do you accomplish that?
So it came years ago, standing in line at Chipotle, watching, you were standing in line at Chipotle, you can't wait to get your burrito. You're on, you got to get back to the next thing. It's a very long line. And I got to counting heads behind the counter just to keep myself entertained. And I counted 11 people behind the counter at Chipotle doing burrito construction. So I had to ask myself, why is it necessary for them to have 11 people to be successful in burrito construction when there's only me and Ellen doing this intricate financial instrument? And so I started constructing in my mind a process as I'm watching them do this, and the people in the back that you saw heads bouncing around, on how could we duplicate that in the lending industry? And it took me years to get there, but we got to the point of 11. Now I've doubled it to 22. I got as much as 33 people on my staff, but because things have happened with the market, we shrunk it back down to key personnel, and so 22, and they all have a structure. Now, have you ever heard of Larry Yatch? He's a former leader of SEAL Team 3. He was actually Jocko Willink's boss before Jocko took over. So it kind of tells you the kind of guy we're dealing with. Very, very heavy, hardcore processes and systems guy, and understanding to how to plan things to work. And when you have a guy like that who came in, he's a very good friend of mine, looked at my operations and helped us build out our operational procedures. What's funny about the meeting with him, Larry is an extremely cerebral sumbitch. I've never met a guy with a mind like this. And when he will get into your mind, just asking you questions. He could literally negotiate into you saying anything, and he could help you understand some things that you're up against as possible barriers for your success or barriers for what you're trying to accomplish in life. And he can do this in a matter of minutes. Within a couple hours of first sitting down with him, he said, "Hey, you take a few minutes." I'm like, okay, cool. You go take a few minutes and tell me where we screwed up. He goes, "No, you guys literally are freaking frying my brain because of how complicated our systems and how complicated our business is." So to have a guy like that who saw how complicated it was and appreciated how complicated it was and what we were doing, then to help us streamline it, make it that much better. That's what I can attribute my capability to do all this to, is I can focus on what I need to do. It's kind of like when you hear Larry describe it in the SEALs, you got your line of fire and you just ignore all the other spots that you need that you could be taking fire from because somebody else has got that. As long as you got a great team that know what they're doing, they stay focused. Now, they're still humans, right? There's still emotions. There's still things that personalities you got to deal with, but they're, for the most part, taking care of their coverage. I can focus here. I can be on this show with you guys and not worried about, is the deal getting closed? Are they locking that? Are they getting that appraisal ordered? It's all getting done. I don't have to worry about it. I just have to get out there and make sure the content that we drive is very, very good, that we're understanding the markets, and that we're helping our investors be very successful at what they do. Because if we don't have them, we don't have anything.
Yeah, well, Aaron, and I can attest that. I mean, I've used you a few times for my rental property purchases, and you got a team. So you send an email, and I know it's going to a couple different people, but I'm always getting the correspondence and response from your team is fantastic. Particularly a lot of times
about that, I hope doesn't feel too impersonal.
Mm-hmm.
You being on that side, how does that feel? I mean, I know a lot of people are like, well, I just want to speak to one person, but it's like you realize how messed up that becomes when the one person is your bottleneck and it slows down your deals and causes you a problem. You can't know everything and it becomes a big mess. And I want people to just not feel that it's impersonal. I'm actually spending an enormous amount of capital to make sure that it is the best experience for you, because I put the best people in the best spots. And I hope that's why I asked the question to you. Does it feel impersonal?
Well, I would tell you what the answer is no. And the reason being is some of those responses, they weren't canned responses. I could tell somebody had read the email and their reply had a little personal touch to it. But to me, I just want to get this done. I want to get this thing done in the time before I'm supposed to close. And I don't want to have any surprises at the end. So that to me makes it very personal. But
Aaron, I got a question for you. What was it that made you bring Larry Yatch in? in your not
Yeah,
just
no.
Larry, but like what was going on in your business, or what were you trying to get accomplished that you're like, hey, I got to bring somebody from the outside in to take a look at this.
So I met Larry at an event that I'm actually part owner. If you guys ever heard of the Power Room, I'm involved in the Power Room there, and it's a big mastermind. They brought Larry in as one of the original speakers when we first kicked this whole thing off, and very, very interesting guy in his take on things, and he really understand what's the driving force that makes a man successful. It also becomes your Achilles heel. And he discovered this in his own process of unwinding the experience he had in the military. They're SEAL for 10 years. You have some baggage, right, that you're dealing with. So the opportunity came, says he's going to help you unravel this crap in your head. So I'm like, hell yeah, I'll be one of the guys who did that. And he did. We found and discovered what makes me successful and what drives me. It's also probably one of the most destructive forces within my system. And so understanding that was where I first got to know Larry fairly well. It was just taking the dive and going and checking this out. And then because we became buddies, and I even carry the knife that he carried. He gave me his personal knife after this experience. And so it goes with me everywhere. And I have a knife carried by an Navy SEAL, a team leader, right? It stays in my person because of the connection we had. There's some it's a lot of story to even tell what happened there, that he handed this to me. He's like, you carry this. Then he took me hunting. I took him hunting with a group of guys. We have that all on video. It's on a YouTube channel. We went moose hunting, got dumped in the middle of nowhere, rural Alaska, in an Inuit village, and then took boats upstream, and we hunted from boats and from the ground right off the Yukon River for 10 days. And we got 6 moose in 6 days with 7 hunters. And it was some of the most amazing, some of the most treacherous, some of the most dangerous fun I've ever had in my life. And it was exhausting. Completely exhausted. Can't begin to tell you all the shit that we went through, but that builds a bond. Larry and I spent a lot of time out there together, and when you're cutting up, you're basically skinning and gutting and deboning an animal out in the field and carrying that for a couple of miles, and you've got wolves and you've got bears and you've got guys getting wore out, and you've got just you and your sidearm and your SEAL buddy, and we're trying to stay alive, just doing what we're doing. It's awesome. So then I understood more of what he's doing. It's like, I need to find, where is it? I'm always chasing perfection. I'm of this mindset that there is that Lendingtopia exists out there somewhere, and I'm going to frickin' find it. Now, the longer I go and the more I work towards it and the more energy I put into it, the more I come to the realization I will die just outside its gates. You will never, ever achieve perfection. You will never, never achieve your goal. Your goal has to be so big, so lofty, so unachievable that you'll never get there, but you're going to keep driving to it. And I've determined now that when I go to the grave, I'm coming in hot because I don't intend to stop. I have this drive to find this peak of something that's unobtainable. And so when people ask me, what is your goal? The best thing I can describe is I'll ask them, tell me that when you hear the name Charles Schwab, whose face pops up in your mind? Or does a face?
Are you asking me?
Yeah, I'm asking you. What face or does a face pop in your mind?
Well, Charles Schwab, I know an advisor that works for Charles Schwab. His name's Mike. That's the first face that came out of my mind.
So, it's just, Mike that works for Charles Schwab, but when you think Charles Schwab, it's green letters or whatever it is. It's a logo, right?
Yeah.
That's what pops into your head. So eventually what my intent is when you hear Aaron Chapman, you don't remember that bald bearded redneck. What you think of is real estate investments, finance experts. That's what you think of, and so I don't know that could be achieved in my lifetime, but if it is, it'd be phenomenal. That's where it is. And so for me to get there, I had to figure out, what do I got to do more? And then you spend the time with a guy like Larry. It's like, he is going to help me get there, and I'm going to get there. And so I brought him in, and to have his endorsement, to him to say, you guys are the most complicated damn thing I've ever experienced. And then for us to write out 115 pages of processes and procedures. I mean, you literally know who clicks what, when, at what time in our team. And it was written by my team, not by Larry's team. They coached us to write it. I think I have a better shot at getting to Lendingtopia than anybody else in my industry.
Awesome. Well, Aaron, let's jump into it. I think where people want to know is, we want to dive in about interest rates. And before we dive into kind of where they're going, can you kind of how are they determined? A lot of times people focus on the Fed rate, but tell us, Aaron, how are mortgage interest rates determined?
Yeah, they do they do focus on the Fed, or they'll focus on the 10-year. They'll focus on all these different things. They'll shop banks, think that banks actually determine them. In reality, it's determined by the supply and demand of money. You guys seen The Big Short?
Mhm.
Yeah.
Okay, so The Big Short talked initially about a guy by the name of Lou Ranieri, who worked for Salomon Brothers, and he was looking at the mortgage industry, which was literally your local bank. Your local bank would attract all the deposits from the people in the community. Then they would take it and house it, and they would lend it out. That's how they made money. They pay the person to deposit their money in a checking savings account. So let's say back then 4, 5, 6% return, which is a significant return for a checking or CD or whatever that might be. But they're charging like 15 to 18% on the money. Right, so they're making that spread. That was a lot of money being made in the lending space. So Ranieri's like, well, why can't we do that on a big global thing? He was in the bond market, so he could sell these chunks of, basically people buy into this bond. You give us $25 million, we will pay you X amount every month to use your money, but we will lend it out through larger channels, right? To the people buying houses to live in. It's secured by their promise to repay and the real estate itself. And that created the mortgage-backed security and created, where Fannie and Freddie came from to securitize these loans and back these loans, and you to create a whole other side to the markets. And they became like this big thing where people couldn't get enough of it because of how much money is being made. Then you get to the crash of 2008 because they were creating more pools than because of the massive demand. And some of these pools were just complete crap. But people were paying for them because they wanted them, because they were paying like crazy and they were getting huge returns on them. So they were just making things up. Then you had that crash and everybody comes back. So what I'm going to share with you guys, I'm going to share with you a screen here that will show you the actual mortgage-backed security and where it is. And actually, I'm going to show you all the way back to 2008. So this share screen process takes a few clicks to get here, guys. So I appreciate the clemency on this. So what this does, this will show you what a weekly, I think it's probably a monthly, every single one of these lines, whether it be a red one or a green one, represents 1 month's worth of trading, or somewhere in that range, I believe. That's actually about 2 weeks worth of trading, for I can tell here. So we go all the way back here. I'm going to see where my cursor is at. This because of its 2 weeks worth of trading, it's not going to give you the exact date, but November 25th, 2008, right over here, hard to see on your guys' screen, but that day was when the Federal Reserve announced quantitative easing. So that day is where everything goes above this line definitively and stays above that line, this yellow line that I drew. I drew that yellow line right on the price point of the security the day the Fed announced quantitative easing. When they announced that, meaning the Fed was going to take, because of the crash, there was not a lot of capital going into the markets, not a lot of people wanting to lend. They were scared to lend because of the foreclosures and all that. Fed says, well, we're going to give you so much liquidity, you can't have any choice but to lend. So then when they announced it, a bunch of money got poured into the mortgage-backed securities, and then the Fed started in it in 2009, which is right about here, and they stayed in it. And they stayed in it.
Wait, Aaron, what do you mean by the Feds got in it?
The Federal Reserve itself had taken money from the U.S. Treasury, filtered from the Treasury to the Federal Reserve, and started buying into different securities across the globe. Mainly it was T-bills, Treasuries, and to the mortgage-backed securities, or the MBS as they're referred to. And then also they started doing some corporate bonds. They were investing in our economy. And
now,
so
how common is that?
That's completely uncommon. Has not happened before that I have any charts of, other than this window of time.
Okay, I didn't think so, but I just wanted to point that out. I mean,
yes, so that's not something that happens at all. And so what you have here is, well, the thing is did the Fed have the money to put in there? Did they have $9 trillion to put in there to begin with? Not really. So what they had to do is they had to create it. It was created by the U.S. Treasury, and then it filtered out through the Fed. And the Fed is actually a private institution, which is the bank of the banks. Right, so the banks got to go somewhere to put their money and do their trading and exchanging. They go to the Federal Reserve. So the Federal Reserve has multiple different locations across the United States, and then those who run the Federal Reserve, like St. Louis or New York, or I think there's the Fed of Atlanta, and all these different ones. What they do is they will come together and have their governors meeting, and so that's how you get monetary policy being put together. Well, with all this capital being invested into it, the interest rates started to drop because there's more and more capital, supply and demand. Not a lot of demand at the moment. People were scared to buy, scared to get into any sort of loan. A lot of people didn't qualify because they had all these foreclosures. They had problems with the credit, all that stuff that happened. But you had tons of money going in, so the interest rates kept dropping. And because that money kept flowing in, we saw this long period of time of extremely low interest rates. So you get to 2017, and in 2017 is when the Fed starts saying, we're going to do quantitative tightening, means we're going to put less in. Now, they have all this money that's been put in, and every time they get a payment or return on interest, they just reinvest that and reinvest that. So it's just a snowballing growth of capital going in there. They said, we're going to stop doing the reinvestment. Well, it freaked out the market. They called it at this point, called the taper tantrum. And so the whole market freaked out. They started selling their shares off, getting out of the mortgage-backed securities, causing some disruption in the markets. The Fed back in 2018 or late 2018, early 2019 said, okay, we'll go back in. And then you get to the point of the pandemic. Now, you get to from January 1 of 2009 to the end of March 2010, the Fed had invested $1.25 trillion into this to stimulate the economy. And you go all the way forward to 2020, you have March of 2020. On March 20th, they decided to do some heavy reinvestment because you had massive sell-off of that time because of the pandemic. The pandemic caused massive disruption with stocks dropping significantly. And when you think about banks, they don't take your deposits and stick it in the vault, right? They take your deposits and they put it to work in the market. Well, a lot of that will go into stocks. And when it goes into stocks, there's a good solid chance a lot of it's on margin. And when those margin calls come in, they've got to pay those margin calls. How do they pay those margin calls? They got to sell tangible assets. Some of those assets were mortgage-backed securities. There's other things that were going on in the background too. That's just one little sliver of it. But because that, a lot of sell-off in the mortgage-backed securities pools, causing the rates to spike quickly. In fact, during that first part of March up until March 20th, I couldn't lock a loan. I would sit there with 50 loans ready to lock. And we wouldn't have pricing up. And I would just all day long, just recycle until I saw pricing up. And I would immediately instant message 4 staff members, and we would all log in together and just be locking. So my licensed staff members that can lock in certain states would help me lock, right? I had people corporate helping me. So I was the only guy who had a bunch of loans already locked. So we're locking 50 at a time. And then all of a sudden the window would close and we couldn't lock anymore. It's just so we can keep closing deals. My competitors that I talked to on the regular at that time, they just like, hey, we just shut down business, can't do anything anyway. I took advantage and stayed at it. Little windows, 10 minutes here, 20 minutes there. I could probably lock only once a day, but we would do tons of them at once. And we kept going. Now, what the Fed did from March 20th to March 30th, they invested another $1 trillion in 10 days to get this market back on track. And that was represented just a little blip right here is all you can tell. But you get all the way up until the end of October 2021, they announced full-on quantitative tightening. And that's where we see the face fell off of this whole thing, dropped off a cliff, and we have interest rates tripled practically. Now, what's key here and what I'm showing is this yellow line that I established nobody was talking about it. Nobody ever went back and talked about what happened in the past. Nobody talked about the price of the security back in 2008 when the Fed announced quantitative easing. So I went back and I looked, and that's where I established this yellow line was the day they announced it. So fast forward to now, you've got where we broke below that line back in September last year. Of course, climb back above it. Traders worked their way back to what's called the 200-day moving average. We got all these different lines represent a different time frame. This 200-day moving average, 100-day moving average, 50, 35, 20, and 14. So you can see the average of how the security prices out. But every time they hit the 200-day, they would sell off. Every time it hits the 200-day, it'd sell off. There's only 4 days that ever stayed above the 200-day for any definitive amount of time, but it's always selling off when it hits the 200-day moving average. That's a price point that nobody wants to stay above. Everybody sells their position there. Well, interestingly enough, it passed that point on May 24th, actually it was May 25th of this year. The 200-day moving average dropped below the price point established in 2008 when they announced quantitative easing. My belief is this is the point what we have seen the lowest interest rates that we will see for the foreseeable future is really this day, which was, they're all back here. These days long back before here, but that day right there marks the date that we're not seeing it going lower, in my opinion. So if you scroll forward a ways, You can see that 200-day moving average will continue to drop a bit, maybe even settle out. Who knows? But we're going to play in this range. We're right here today, right at this point. We're going to play in this range, probably down to here, driving interest rates for the real estate investor somewhere probably, I would guess, in the 8s, high 7s, low 8s. It's possible we reach the double digits. I can't say for certain that that's going to happen, but I believe that that's where we're going. Now, a lot of people are freaking out saying, wow, I can't believe there are markets going there. There are some lenders, no, we're going to get back to a normal market. But most of these guys haven't been in the industry long enough to know what a normal market is. There's a lot of people who have been in the industry less than 10 years. Well, quantitative easing was started in 2009. It was announced in 2008. We're not far from that being 20 years ago, right? So we're 15 years that they announced it. Well, if we're 15 years from announcing that, and people have been in the industry 10 or 12 years, they have no idea what a normal market is. So let me share this one thing with you guys. I'm taking away all your questions away from you.
No, this is great.
You know, Aaron, I did. Let me just ask one burning question. You had said that you saw the lowest rate we're ever gonna see. What rate is that?
Well, the lowest rate we're ever going to see was back in the 2s when we got that a couple of years ago.
No, but I mean, when you were looking at that 200-day average.
I think that lowest rate that we're going to see, like in this year, is probably somewhere in the range that was about probably 7. I'm going off the top of my head, probably close to like 7.3, 7.4 with a couple of points.
Okay.
And there's a reason why the points is there. We'll get into that.
Okay. Now, and one thing I also want to mention, you mentioned how much the government had injected into the market. So I know I at least heard 1 trillion twice.
So
right?
1 trillion separate things. So it's 1.25 trillion from January of 2009 till the end of March 2010, 1.25 trillion. And then during the window of March 20th to March 30th of 2020 for COVID, that was a full trillion. But across the market itself is about $8.9 trillion.
Okay. Now, we've touched on this a little bit, but if we look, I mean, and Aaron, just to clarify, where'd that money come from?
Created by ones and zeros in a database.
Okay. Yeah. When you hear people talk, this is for some of our listeners in Cameron, right? When you hear about their
just here for sex bill, right?
This is exactly it, right? Where the government is ability to print more money, and they've increased the money supply 3 times. If we look back to 2008, you probably know the numbers better than me, Aaron, but when we looked at the money supply, it's 3 times higher than it was in 2008. And I know a lot of people are blaming the other side for inflation, but if the government is tripling the amount of money supply, the dollars are going to be worth less. And I think there's a lot of things that go into inflation, but to me, I think the biggest attribute is the amount of money that they're printing.
Well, what people, and I know it's kind of hard for them to wrap their head around how the dollar's value is impacted so much by printing capital, that supply and demand thing. I tell them is, put yourself in an auction and there's 100 people in there and they all want one item. And there's only one of those items. How expensive is that item when they're done with all the bidding? Same thing if there is 200 of those items and there's only 100 people in there. How cheap is it at that point, right? So right now, that's what we have done. I'm trying to pull up a site so I can go get into the money supply, because the money supply is freaking huge. It's actually bigger than what I think that you were just indicating. There's a lot more in supply when you start looking at some of the charts that are out there. But it's ridiculous what we are experiencing and how people know so little about it, because there's so many big words being used: quantitative easing, right? Quantitative tightening, all that kind of stuff. They're using words that sound like they mean something significant. In reality, they're just taking a big word and going to town. It's like listening to some guy just making shit up. Right? Because it's really what they do. There's a lot of people you hear on our president right now. He just makes shit up. He doesn't even know the word, right? He's just babbling on about whatever. Same thing. And that's what we've got here, is try and confuse the people the best they can. So money supply has gone through the roof. It's gone out of hand. And then you've also got the fact that we don't have a historical data on what happens when you create money supply like this. If you look back 2008 at the charts, I'm trying to find these particular charts. It won't let me into this site. I have no idea why I can't get in there, but I was wanting to be able to offer this information, because this right there will it'll completely blow your mind as to what you're getting. And that looks like it's going to let me in here. So with that,
what website you go? What website you going to, Aaron?
we're going to shadowstats.com.
Okay.
So if it's and I don't know why, maybe they took it down. Maybe they don't like it. Right. It could very well be they don't like it. So one thing that we do want to talk about when it comes to interest rates, while this is coming up, and you're talking about the money supply and it's driving things the way it is, and I can't get it to come up for some reason. It is just not liked right now, and I think that's, who knows, maybe somebody took it down. But you can go in there, you can see the time value of money, you can see money supply, how inflation is being impacted, how the real rate of inflation is. It's well over 12% right now. It's not what the Fed is claiming it to be. So the other well, I had something that was in my head here for a second. Oh, Warren Buffett. So, but Warren Buffett would and Charlie Munger, you know those two names, right? So Charlie Munger was recently interviewed, I believe, by Aaron Burnett at CNBC. I'm going off my memory here. And I've seen that interview cut up 100 different ways. Yeah. And in one of those that I had seen, when you watched it, he talked about interest rates. He said, we have had 40 years of declining interest rates that they are anticipating. He expects 40 years of increasing interest rates. Now, what's funny about that is I click on that link now, it does not pull anything up. It says it's private. I have spent about 6 to 8 hours, I didn't clock all of it, but searching through every version, edited version of that interview, and that has been taken out. That doesn't exist. I searched for the transcripts for that interview. That does not exist in the transcripts either. So for a guy like him to say we're going to see 40 years of increasing interest rates means that, people, you need to get your shit locked in now. Because if it's truly what it is, then we saying the lowest interest rates we will see this year for the foreseeable future is correct. And if that is correct and you lock in, you protect yourself. Warren Buffett said that the 30-year fixed is the greatest financial instrument in history because it's a one-way bet. When you lock it, if the rates go down, you just lower the rate, you just refi. But if it goes up, you've protected yourself. What we have is people's misunderstanding of the market, misunderstanding of what history has been of our markets and what drove interest rates to where they are, that has convinced a lot of people to take an adjustable rate mortgage, take a lot of people to take something a little bit different than what they should have, sometimes 100%. There's 100% financing out there for investors right now. And they're claiming it's for the seasoned investor. If a person's really seasoned, you're not going to take that damn loan. That does not make sense to me, right? The ARMs, 5, 7, 10-year ARMs. Somebody's selling you ARM, you turn and you walk away from that person because they don't get it. What they're trying to do is just get you to close. If they're telling you rates are going to come down in the next few years, guys, they're full of shit. They don't know. If they believe that, they're going strictly off of hope, and hope is not a business strategy at all. If they do go down and I'm wrong, then you refinance from your 30-year fix if you're really that driven by rate, and you shouldn't be. But if I'm right, what do you have by going that direction versus my direction? I just think that it's a time right now where there's a lot of people preying upon people. I am of the belief that the thing that I hate most about my industry, it's full of predators. But the other thing I love about my industry is it's full of predators. Once you realize who's a predator and who's not, you align yourself with the people who are going to keep you protected, and they will, because there's enough predators out there that will push you away from them and get you to safety. And that's what my team represents.
Now, Aaron, great information. But can we go back to the question? What's determining mortgage interest rates?
The supply of capital going into the mortgage-backed securities as those go up. So that in fact, I can kind of zoom in on that just a little bit more here to determine on a day-to-day basis what drives it, so it gives a little bit more color to it. I showed you that big ass chart, and I told you about all these other things, but I didn't get into how does that translate to actual interest rate. So
yeah, and what is and so I'm sure there's something that's driving money to this investment as well, right? I know you're talking about the supply and demand, so maybe talk about what's incentivizing people to invest in mortgage-backed securities.
Well, we'll definitely get into that. So every single one of these lines here that I'm showing you, the green ones and the red ones, represent 1 day's worth of trading. So as somebody, let's say right here, this day, for some reason, I can't remember what it was that happened. I have to go back and look at my research and my notes. What economically, something happened that drove a significant amount of capital into the mortgage-backed securities, right? And they bought into that day. And then you see them continue to buy into it. Then you see some sell-off days. So where it starts low and ends up high, that means it was money going into the security when it's a green candle, right? The red candles mean it started higher and went lower because they sold their positions. They got out of it. Why they would go into it is because economic data looks like inflation is probably more under control. When it looks like inflation is more out of control, they get out of a long-term instrument. So think about the time value of money. I talk about it a lot. If you're getting something, you're locking in a cost. When you buy into this, it's a bond. It's a fixed return for 30 years. And if in that 30-year window, what they're paying you back with is going to be worth more in value down the road, then it's a great thing to lock in for 30 years, right? If I locked in something for 30 years, you're going to be paying me back, and what you're paying me back with has an increased valuation, then I'm doing better. But if it's a decreased valuation, then I'm losing by having bought into the security. So the higher inflation goes, the more people want out of bonds, because we're buying into something that's going to be long-term. Inflation's going up, meaning the dollar's worth less. And the only reason inflation goes up is because there's too damn many dollars chasing too few items, right? So you're getting paid back less and less and less the longer it takes. So they don't want a person really to ride this thing out for 30 years. So it's attractive place for people to park capital while you have more volatility somewhere else. So you'll see bonds moving positive when things are negative, very negative in say equities, because of how volatile it is. But what we got going on in equities, there's a lot of pumps out there, people pumping up valuation of stock. It's amazing how you can have companies that are making huge returns in their stock, but their actual day-to-day is not generating any revenue at all. But it's a company value because of what it represents, not what it actually creates. So it's a very, very interesting economy. I don't see great reasons to go into mortgage-backed securities other than they've got to park capital somewhere that's going to make some sort of return while they're determining where else to put the capital. And you're talking about like hedge funds or pension funds or things like that. Large chunks of capital sitting somewhere. It's got to be put somewhere working. Sitting in a bank account is not making you anything. Going over here making 5.5%, because that's what this coupon is a 5.5. It's a hell of a lot better than going into a bank account making 0.01. So that's one of the reasons they go into a bond, because it's a set rate of return. And they got to move that money out there into the mortgage, out in mortgages and out into people's houses, so they can pay those returns and the bond not fail.
Okay,
Well
so
done.
a lot of times people put a lot of pressure or emphasis on the quarterly Fed meeting and where they're raising rates. How or does that affect the price of a mortgage?
It affects it in the sense of how it affects inflation.
Okay.
So as we were just talking about, inflation it erodes the bond's value, because if inflation is going up, the dollar's losing value. Whoever's holding it for 30 years is making less money because you get paid back with an instrument that's declining, which is the reason why you want a 30-year fix, because you're making money as somebody else is losing money. So when the Fed meets and say, hey, we're going to raise interest rates, what it does, it increases the cost of everything out there, whether you're a bank, whether you're a person consuming. Therefore, it's supposed to slow people down from buying things. The more expensive it becomes, the less you're actually going to buy it, right? So if you walked into your favorite restaurant and you love their ribeye, you're okay with spending $100 on your ribeye, because it's only be once every few weeks, right? But if you got the ribeye that's sprinkled with gold dust, which I've seen that stupid ass thing on a menu, and it's $800. Now, are you going to buy that? No, it's the same damn ribeye. It's just sprinkled with gold dust. Somebody just says you want to just shit gold. Fine. You might feel good about yourself for a half a minute, but it doesn't have any value, right? So it's kind of the same thing. Is they're trying to increase the cost of things to a point where people are like, we can actually go over here. In fact, they have an index when they factored in the CPI, the consumer, they had a replacement index factored into that consumer price index, where, a person might have a lifestyle where they eat steak this year, but the next year, maybe they're going to go to chicken because things are a little bit more expensive. And then that next year, maybe not chicken, maybe they go to ground beef, right? They have a replacement index. They can still fill their belly with, whether it's 6 or 8 ounces of meat, but it's a different meat. So we can not really factor that cost into the consumer price index. And therefore, the inflationary factors that we've been given are wrong because of that replacement thing. But they're still attacking people spending money as a whole by increasing rates and increasing costs. And right now, I know for them to try and even continue to keep attacking it, they're attacking jobs. They've got to get less people working, so there's less money in the economy, less money chasing things, shrink the inflation back down to a manageable scale.
Perfect. Now, Aaron, thanks for this information. We are streaming this on YouTube and Facebook. So if you're watching us and you have a question for Aaron, feel free to throw it in the chat. Now, if you're listening to the podcast and you want to make sure you don't want that ability to ask questions, we'd suggest you subscribe to our YouTube channel. So this way, whenever we have a podcast interview, you'll be notified so you can ask questions.
Aaron, thanks for kind of peeling back the curtain on some of the things that are driving kind of these interest rates and educating clients. You have a YouTube channel as well, right? What's the name of that?
You just search Aaron Chapman. You know, what I do is I go over the interest rates in the market and what's happening in the economy and the market twice a week to give you an idea of what's going on and how it influences you as a real estate investor. You know, and one thing that we do touch on is, you know, some people say we're going to get back to a normal market. I know we're getting long in the show here, but you know, one thing that I want to make sure people see before we get too far, and I'm just hijacking crap. I know Cameron's got this look on, so like, dude, you're not supposed to do that. This is my
no, go, yeah.
So
good.
What we've got here, and I know I got Anthony. Oh, you guys have the power. You can tell me you can't say crap. You're good. You still have to agree to it. So you agreed to it. So what I want you to see here is I've got 2,733 lines of data here that go back to interest rates all the way back to 1971. And when you average it all out, the average interest rate for the homeowner, a person buying a house to live in, since 1971 on a 30-year fix is 7.74%, according to Freddie Mac. Me taking and downloading all the stuff from them and then me doing the averages. If you look from 1971 to 2009, pre-quantitative easing, which we've been talking about, the Fed dumping in all this capital into the market, from 1971 to 2009, it was 9.12%. That's the difference that quantitative easing made, dropping all the way down to 7.74. Now, that's the rate for people buying houses to live in. We know real estate investors financing houses or financing duplexes, triplexes, fourplexes, whatever, they pay 1 to 1.5% higher in rate. So we know average since 1971 to 2009, it was a much higher rate for the real estate investor. Now, some people ask me, well, what can we expect? Well, I'm going backwards in my charts to 2008. I'm looking, what did things look like from 2000 to 2008? The average rate for the average homeowner from 2000 to 2008 was 6.48%. So 6.5. If you look at bankrate.com right now, the rate that they're saying is the average rate for a person with a 30-year fixed buying a house to live in is 7.25. So we're well above what that is, that average from 2000 to 2008. I believe we're going to go to that point. We're going to be hovering in there for maybe, I don't know how long in the foreseeable future, but real estate investors understand a normal market has nothing to do with what on during quantitative easing from 2009 to 2022. What has to do is what was before that, before $8.9 trillion influenced the market. So we should expect probably somewhere in the 8s to 9% for real estate investors. Right now, you cannot get a loan without paying points. There's a reason that I believe for that. The reason I believe that it's there, if you opened it up to a 0-point rate would be in the mid 8s right now. Well, if you see a rate that's lower than that, you would literally refinance as fast as you can to get out of that rate. But if they had you take a lower rate than what the rate should be right now and make you pay points, you're going to stay in it longer. And if you stay in it longer, the people who securitized that loan have a chance to make their money back because it costs them a few points just to get that deal put together, securitized, set up for servicing. Then they got to wait to make interest off of you just to even break even. If you refinance anytime soon, they lose a pile of money, will implode that sector of the market. So right now, people are paying points because they need you to be settled in for a little while. Well,
Aaron, do you have the option to take the higher rate with no points?
It's not available right now. They're not allowing us to go above that 7.625, I think is the rate that I see on my sheet, 7.625, maybe 7.75. But you're going to pay points to stay in it for a while because if you took the lower rate, right, it'd be 8, say 8.5. If you took the rate with zero points, the lower points would be like 8.5. And then if the rate's right down to 7.5, you'd want to refinance because we've been programmed to think that way. Don't think that way. It's a whole other show. I could go on for hours. don't think that way. But if you saw 7.5, how many people would refinance? What happens then? Now that particular part of the market didn't collect their capital. We got a big problem on our hands. It's going to create more issues. Mm-hmm. But if you get the 7.5 that you would have refied into, but you paid 2 points to get it, you're going to stay in it.
Perfect. Aaron, with our listeners, a lot of them have a varying experience. Some of them are experienced investors, and some are new to the game. And then they're new to the game, and then they're seeing how expensive interest rates are. What advice would you give somebody who's new to the game?
Well, one, get in the damn game, right? Everybody keeps thinking they're going to time the market by saying, I'm just like a star football player sitting on the sidelines. I'm going to watch for the perfect play before I jump onto the field so I get in the highlight reel. The only people on the highlight reel have their asses on the field, period. So get in the game. So what you need to do is understand what is the game. It's not the interest rate game, and it's not the price game. It's the what can I keep reasonably rented for the entire time I own it, and what can I raise rents on? What markets will keep renters in my home? That right there, if you want the number, you're going to have to call me. You're going to have to go to aaronchapman.com. You have to hunt me down. Just Google my damn name if you want. Schedule an appointment, and I can show you how you're literally making 20% on your money, your investment, the down payment plus costs within the first year, averaged over that 30 years, just by having somebody reasonably in the house for the entire time you own it, and not even raising the rents. But you start raising rents, you're going to make more. So you also have to be in a market that's going to at least appreciate 2.5%. Between those two things, you're making 20+% on your money. Then you get into the cash flows, then you get into the tax benefits, and then you start finding 30 and 40% return on your investment. You got to think correctly about this. So get in the game and get with the right people. Quit chasing around freaking interest rates. I've got I'll send you guys the links for it. I've got an app called the QJO investment tool. It will help you calculate the time value of money. It's named the QJO investment tool because it's the quit jerking off investment tool, which is what you're doing when you're chasing around trying to find a rate. What's funny is there's so many people that'll just start calling lender after lender after lender after. They'll spend days looking at who are going to get the best interest rate from. And by the time they're done finally settling on somebody, it's a higher rate than what they could have gotten with the first guy they talked to, because they spent so damn much time wasting time looking for rates. Quit jerking off and quit wasting time on things of zero value. Find somebody you trust and just do the damn deal. And if you want to try and find a better way to get a better rate at a better time, people know how to watch the market. That's all we do. Myself and Scotty Bear on my team, we stare at the market all damn day. Scotty helps you negotiate the lock. He helps you understand which is your best time to lock for you at that time. He will communicate with you like crazy. It's his whole job to communicate rates. That's it. So find people that take care of what you need, and then listen to them and quit getting jerked off by the damn market.
Aaron, you just mentioned kind of two mistakes. One is somebody standing on the sidelines, right? Get in the game. The second one, I think you gave the answer, but I'm going to ask the question here. Is that one of the biggest mistakes that I see people making is they're making extra payments towards their mortgage. And that's usually the time in which I bring up your app, but that would be kind of the second mistake. What do you say, or if somebody goes to your app, what are they going to find out? Like, what is that going to show them?
Well, you're going to find how inflation plays a factor in your payments over a period of time. So we just talked about how the average rate of inflation is much higher than what the Fed wants to tell us. If you look back in history, you can see that we've been above 8% pretty consistently since the 80s. Well, if we're using 8% of our benchmark, that means the dollar is losing 0.666% of its value every single month. So you borrowed it at today's dollar value. So let's say a $200,000 house with 20% down, it's a $160,000 loan. Over 30 years, you're going to pay $402,000 in principal and interest on that. And people are like, I want to pay that off sooner. But it's not your money, right? So using your tenant's money to pay it, you get to siphon a piece of it off, and then you get to give the rest to whoever it is you borrowed the money from. But as you give it to them, it's worth 0.666% less, at least, than it was the month before. And so on and so on. So when you recalculate the value of every dollar as it leaves your hands, from the day you borrowed it to buy a cash building, not flowing all the time, but cash building, equity building, wealth building asset, like buy and hold real estate, you're paying it back to the tune of about $152,000 and change. You gave them less than what you borrowed. The faster you pay it off, the more you give them the dollar, well, it's worth more. You keep that extra and you reinvest it somewhere. People keep wanting to use that capital to try and, I want to be able to retire next year. I'm 32 years old and I want to retire by 33. That's insanity, for one. I'm 48. When I go to the grave, I'm coming in hot. So when you're talking about that capital, it should be going reinvested and reinvested and reinvested and reinvested. So when you do hit a later age where your body can't carry you to do things, have great experiences, go on trips, do all that crap. But when you get to that point where you can't, you have built a massive engine that's going to create wealth for you.
Awesome.
And of course, we haven't gotten to the infinite banking crap, how I use that. I mean, the baseline engine that's going to build the wealth. If you do not have a policy with these two sumbitches, I know you don't watch them just because their sexiness and their looks. There's got to be another draw. That draw is what they can help you build as a foundation for your wealth. It is by far the holy grail, in my opinion. If you want to hear the big old speech on that, we'll do another one of these damn things, and I'll stare at these sumbitches again, and you guys out stare at them, and we'll talk about that.
Aaron, briefly, what's a couple of the differences between using a policy versus cash, right? From a loan originator's point of view.
The biggest difference, well, from a loan originator's point of view, it's no different because it's different from a loan originator that's not Aaron Chapman, because those guys don't freaking get it. The majority of the banking industry has no idea what you're talking about. Do not talk to those some bitches about it. They don't understand. From us, it's the same as cash as far as what you're bringing to the table. But what it tells me, I got a smart son bitch on my hands that's using the infinite banking strategy to get started, because if I have $100,000 in a policy loan or $100,000 in my bank account, I pull the $100,000 from my bank account to buy investment real estate, and I die 2 days later, my family has investment real estate in an empty bank account. But if I pull it from my policy and buy into some investments and die 2 days later, they have the investments that I purchased. Now they also have this massive death benefit that comes in and shores everything up. It's just a smarter way to go. The other thing is I take the cash flows plus 10% of my income, I start paying back the policy loan. And as I get it paid down enough to pull more, I do it again, and I do it again, and I do it again. I create this engine that literally creates a need to keep going and buying more assets. When those assets pay off, it comes back, reinvest it, because it's your money anyway. And then when I pass, here's the other thing that's amazing about this. It's life insurance. It insures you on having a life that you can live the fullest. And what I mean by that is I'm going to spend every damn dime I have that I made before I die if I can. When I die, I'm not leaving a freaking thing to my kids. Why? Because when I die, I leave them more money I ever touched. So my death benefits are so huge that they can literally they can change generations with what they're going to get from my death benefit. So why am I going to leave them a single freaking penny? I need to use that to ensure I have the life that I want. So that way they will have that return or that death benefit to go to our trust. They'll ensure that they have the ability to have the life that they want, that they can use their capital because there's enough left for the next 3 or 4 or 5 generations.
Well said, Aaron. Thanks again, man. As always, just a ton of knowledge and information. We're approaching the top of the hour.
Yeah. Yeah. And I know you're a busy man, Aaron.
What do you guys usually run?
You know what? It varies. About 45 is probably the average.
Okay. So just slightly above average. That's what my wife says. I'm above average.
Does she? But anyways, but no, Aaron, it's always great information. And I would definitely recommend that you subscribe to his YouTube channel because he puts down these weekly vlogs twice a week. There's some great information there.
Awesome. Aaron, and where can they find you, right? If somebody wants to reach out to you, get a hold of your team, what's a good place to go?
Well, just go to aaronchapman.com, Google Aaron Chapman. There's only one bearded redneck lender out there. Go to the App Store, get the QJO investment tool. When you download that, you hit the little question mark in the upper left corner. It'll take you right to my site. Hell, just text me, 602-291-3357. I'm not going to answer you. My assistant will answer you, but text me. That's my personal cell, 602-291-3357. You would have been able to find it on your own anyway. You don't have to be a special agent to find my phone number.
Aaron, thanks again for being on. We will certainly have you back. Really appreciate you.
Thanks, guys.
Go make it a fantastic day.
Take care.
Thanks for listening, and be sure to subscribe so you don't miss out on the next episode. Also, check out our website, infinitewealthconsultants.com, to find our podcast along with other additional resources.